In this video, I'll show you why Morpho will be the fastest growing lending protocol over the next years, how it is already powering Coinbase's lending market, and of course, how Morpho token holders could benefit. Let's dive right in. Alright, to understand Morpho, we have to start with its history. Let's recap real quick what lending markets are for. Lending markets are for lenders who want to earn yield on their cryptocurrencies and in most cases on their stablecoins. As you can see here, you can supply USDT into Aave and earn 4.61%. If you lend out your USDC coin, then the rate would be 3.69% and borrowers would pay 5.48%. That is quite a big spread between lending and borrowing rate of roughly 1.5%, and that is how Aave makes money. Originally, Morpho or Morpho V2 was built on top of Aave in order to give people better rates. What does that mean exactly? If someone wanted to lend out their Tether or their USD coin and someone wanted to borrow the same amount and they provided their liquidity over Morpho or took their borrow over Morpho, then they would be matched one-to-one on top of the Aave protocol instead of deploying directly into the protocol and get better rates. In this case, for example, the USDT provider could earn 5.37% on their stablecoins and the borrower would only pay 5.37% as well, instead of 6.13% and only earning 4.61%. Same goes for the USDC coin. In the next step, we have to learn what collateral is and what it's for. So in traditional crypto lending markets, users are generally anonymous. If an anonymous user takes out a loan, the incentive is super high, not to pay back the loan. So the solution to this problem is providing crypto as a collateral asset, meaning an insurance asset, and locking it into the protocol in order to borrow, for example, 100 USDC. They have to lock up $200 worth of collateral to make this $100 borrow. So if they were not to pay back their $100, they would actually lose $200 worth of crypto collateral. Each asset on Aave has an LTV ratio, meaning how much can you lend against this asset. For wrapped Bitcoin on Aave, it is roughly 74%, meaning you can lend $74 against $100 worth of Bitcoin. And for Ethereum, it's 80%, meaning for every $100 of Ethereum you supply, you can lend $80 worth of stablecoins. In this specific example, you locked up your crypto collateral for $200 and you lend $100. That would mean an LTV of 50%. Now, if crypto loses 50% of its value tomorrow, then you would only have locked up $100 worth of crypto collateral in the protocol, which means your LTV ratio would go above 80% because you have $100 locked in the protocol. You lend out $100, that would be an LTV of 100%. As soon as the LTV goes over the 80%, you actually will get liquidated, meaning your crypto collateral will be seized and sold on the open market because lenders have to be made whole at all times. As you can see here in the Aave interface, you have lots of options to supply assets as collateral. Ethereum, wrapped Ethereum, staked versions or wrapped versions of Bitcoin, USDC, etc. And you have plenty of options to borrow as well. All right, let me show you a specific example here just to make it more clear. We have on our left-hand side our supplied assets here, and these are made up out of Ethereum, USDC, and a wrapped stake version of USDC. Those are our collateral assets. All the dollar value of each individual asset supplied is added up. And against this value, we borrowed USDC. We could also borrow any other asset and supply at the same time any other asset that is whitelisted on Aave. Above here is shown the health factor, and the health factor indicates the health of our loan, meaning it sets in relation our supplied value with the loan to value ratio and divides it by our borrows. If the health factor falls below 1, our collateral could get liquidated here. We could add any collateral at any time in order to improve our health factor. All right, to summarize, the traditional DAO lending model consists of lenders, here shown as DAOs, hedge funds, protocols, and individuals who provide crypto assets, and these crypto assets can be borrowed by borrowers who in turn have to put up their collateral. And the risk management here is actually conducted by the DAO. So the DAO or the protocol has the responsibility of whitelist any asset, choose the right oracles, etc. And also, of course, does the liquidity and interest accounting. This traditional model has the advantage that it unifies the liquidity, meaning if you supplied your USDC and all your USDC are lent out at the moment, you could actually withdraw the USDC from someone else, since there is no difference between the individual loans. And that makes it really good for lenders to always have access to their capital, and also for borrowers. They could borrow any USDT that is available in the protocol. The limiting growth factors are here, that the contracts are not immutable. Why are contracts not immutable? Well, I mean, the DAO has to manage these risk factors, and if a new asset is going to be whitelisted, if some changes to the protocol in risk management need to occur, then contracts have to be updated. And that also affected Morpho V0, because whenever Aave changed their core logic of their protocol, Morpho V0 had to change their code as well, because they were deployed on top of Aave. Then this traditional model is not really flexible, because if you want to whitelist new assets, you always have to factor in all of the assets that are already whitelisted, and you can only really choose high liquidity, high value assets, and cannot go out on the risk curve, so to speak, to whitelist other assets, because that would significantly increase the overall risk factor of the protocol. And also it is less flexible in the sense of that a lender cannot really pick and choose and say, oh, I want only Bitcoin and Ethereum collateral for my USDC to be lent out, and not any wrapped stake version of Ethereums or any wrapped Bitcoins, because that is too high of a risk for me, because all of these assets are treated equally under the risk umbrella of Aave. So the lender doesn't really have a choice here to make. Then platform fees are fairly high, as we have seen in the case of Aave. The spread between lend and borrow was roughly 1.5%, because obviously the more assets get whitelisted, the more complex the protocol becomes, the higher maintenance costs are there, and the management has to be paid as well. So now that we understand the advantages and disadvantages of traditional DAO lending models, let's talk about Morpho Blue and what they implemented in order to solve these downsides. So Morpho, on their base layer, created an isolated risk market protocol. What does that mean? They listed markets which have only one collateral asset, for example, Bitcoin or Ethereum, and only one borrower asset. So in market 1, there could be a Bitcoin USDC market. In market 2, there could be an Ethereum USDC market. And in market 3, there could be an Bitcoin DAI market, meaning Bitcoin as collateral and DAI as the lending asset. And borrowers can borrow against each individual market. And that really allows for higher loan to value ratios because now risks are isolated. If market 2 gets liquidated, then this doesn't affect really market 1 or market 3. So this approach is way more capital efficient. Also, all of these markets can be created permissionlessly by anyone. That means that any new asset listing doesn't require contract updates on the main protocol layer, which makes the contracts immutable, which is also an advantage over the traditional DAO model. The downside of this base layer model is that it really fragments liquidity and externalizes the risk management to the lenders who might not want to do active risk management with their funds on each individual market. It is really cumbersome to analyze each of these markets and evaluate which risk the market bears. And also, lenders would also have to rebalance very often their stable coins in order to get the optimal yield, which is really an active process and really time consuming. So what Morpho did to solve this problem is actually introduce a second layer, which is called Morpho vaults. And vaults can be created by anyone really, but in most cases are created by professional money managers. Now lenders can give their USDC into a specific vault, and the vault manager manages all the risks for them and can even rebalance all the positions in the different markets to get an optimal yield. Also, if a vault manager wanted to add a new asset to its vault, it wouldn't take a long governance process. The vault manager could just say, we're listing a new asset, and if lenders were not okay with that, they just could withdraw their money from this specific vault. So now DAOs, protocols, individual can actually choose individual vaults, which also means diversified risk profiles. One vault might be way riskier than another one, but might also have a way higher yield. So in short, because risk and management is now externalized from the core protocol, the market becomes way more flexible for borrowers, but also for lenders as well, because they can actually choose their individual risk profiles. Now that we introduced Morpho Blue or Morpho V1, let's talk about Morpho V2. Morpho V2 will actually have a marketplace for fixed rate loans. What does that mean? You could add collateral assets like Bitcoin, Ethereum, and BNB, and people could lend against these assets. And in Morpho Blue could pay back their loans at any times. This is a very flexible approach, but also means very fluctuating interest rates. The interest rates might be very low one day, but if all of a sudden huge borrow demand comes on chain, then rates will spike and borrowers will have to pay super high rates and lenders get super high interest rates. And Morpho V2 will allow, through an intense structure, to specify the collateral asset and the time horizon, let's say, for example, 30, 60, 90 days, and then the different rates they assign to the different collateral assets and time horizons. For example, a 30-day Bitcoin loan might be very low risk, so borrowers only have to pay lenders 5% for that, but BNB is a bit of a higher risk, and over 90 days, lenders might charge borrowers 6.5%. And this yield is fixed. So over these 90 days, borrowers know exactly what they're going to have to pay, and lenders will know exactly what they're going to have to receive. And the market for fixed term, fixed rate loans is way bigger than the market for variable loans, because bonds and corporate debt are mostly fixed rate, fixed term loans and not variable rate, variable term loans. To show you how big the Morpho protocol could get, let's dive into specific examples here. Coinbase, for example, could launch their own market on Morpho's base layer, in which they put their own version of Bitcoin as a collateral asset, and they lend out USDC to borrowers against that. On top, they will create their own vault for Coinbase app users to deploy their lending asset, meaning USDC, into the vault and earning yield for their USDC in the Coinbase app. Other Coinbase users might choose to borrow these USDC and lever up on their Bitcoin position or taking a loan against their Bitcoin position. Other crypto exchanges might follow suit, create their own market with their own vault, but might also allow their users for riskier strategies and not only whitelist Bitcoin as a collateral asset, but also Ethereum, BNB, etc. and give the same access for their users, meaning lenders can lend out their stable coins and earn yield, and borrowers can borrow from the vault. Also, Ledger could add a function in which they allow their users in their interface to deploy USDC into one of these market strategies. And this is really a game changer because now the vault layer really becomes a shared liquidity layer for all these whitelisted markets. Obviously, Ledger is not going to whitelist every market, but Ledger could be easily lending to Coinbase users, to Crypto.com users, and give their customers yield on their stablecoin positions. But why stop here at crypto applications? Fintech companies could deploy this. PayPal already has their own stablecoin, PYUSD, so the step really is not that big to deploy a vault on Morpho and lend out these PYUSD or other stablecoins in order for their customers to get yield. Also, Revolut could implement the same mechanism because they already make crypto trading available in their app. But why stop even at crypto assets here? You could also tokenize gold, for example, which already happened, and put it onto the blockchain and deploy it into a Morpho market where you can lend against your gold position. Or even stocks are possible. You have a Tesla stock, maybe you want to lend USDC against it. All of this is possible on the Morpho protocol. And if you think that's too exaggerated, well, Coinbase already opened up their own market on Morpho. Crypto.com announced recently that they're going to deploy on Morpho as well. And Ledger already announced a lending program which is powered by Morpho as well. But why would they deploy on Morpho? Like I said before, Coinbase and Crypto.com are able to create their own markets, which is a huge advantage because they could whitelist or delist any asset of their will. Also, they can make it regulatory compliant for their customers or for a specific subset of their customers. Once a market is deployed, it actually doesn't need any maintenance because you don't need to update constantly the risk parameters. The market is deployed and users can just use it, and the platform, meaning Coinbase or Crypto.com, could charge a little bit of an extra fee for it and earn additional revenue through that. But really the most important thing here is this shared liquidity layer. Because of this shared liquidity layer that, for example, Ledger lenders are saying, oh, we can deploy into the Coinbase markets, or we can deploy our capital in the Crypto.com markets or any other markets, makes Morpho the protocol with the best rates because capital is efficiently flowing where it is needed most. Apps are incentivized to share the liquidity on the vault layer. All right, and now that we understand the concept of Morpho and how the protocol works, let's take a quick look at the tokenomics here. This is the token distribution, fairly normal for me. Some people might criticize that users and launch only got a 4.9% allocation. and strategic partners, the Morpho DAO and the founders got the biggest allocations. But in my opinion, that doesn't really matter because as we will see, the token has fundamental value to it. So it should always trade on a fundamentals basis, which will make huge token dumps only a buying opportunity. Let's quickly look at the unlock schedule. So the main part of the tokens will be unlocked between 2026 and 2028 actually. From now on until the end of the year, the token supply will only grow by 2.8% from 31.6% to 34.4%. Until 2028, over 90% of all tokens will be liquid on and tradable on the open market. Then we have to talk about the token utility. Good news and bad news here. For now, the token gives you only governance rights, but in the future, the token has a clear path to value accrual. Morpho has recently resolved its equity entity, which means all future value that will be created by the protocol will flow to token holders, and there will be a fee switch activated at some point. And how the fee switch actually works, I'll show you in a minute. But first we have to talk about the total value locked real quick in order to make a judgment about the valuation of the protocol. As we can see here, from January 1st, 2025, the TVL grew from 5.6 billion to $12 billion, which means it more than doubled over the time span of 10 months. Now let's assume the fee switch will be activated and the take rate for all of the TVL of the protocol is 0.3%. Now the rates for the individual markets will be really dependent on the asset and the depth of the market, but I think a 0.3% take rate on TVL is really a good assumption to make here for the beginning, because we remember back on Aave and the spreads that they take between lending and borrowing, and this spread was 1.5%, so 0.3%. So 0.3% will let Morpho be very competitive in the market. Then it's simple math. We will have to multiply the TVL of 12 billion by 3%. And that's 40 million annualized revenue. If we look at the current price to value ratio, then the protocol is roughly worth $1.9 billion, depending on the day. We divide that by 40 million. That's a price to revenue ratio of 47.5, which seems really high. But if we factor in the growth of the protocol, as we have seen before, the protocol TVL grew over the span of 10 months by 100%. Now let's assume that the growth will be slowing down a little bit, which is really conservative because you can also assume that the protocol growth will only accelerate. But let's stay somewhat conservative here. Then we can calculate a price to sales to growth ratio, and that ratio gives us a number of 0.475, which is in equity terms or in the stock market means undervalued, with a fair value being roughly 1. So the protocol valuation would have to double in order to have a fair value if you consider the rapid growth of the protocol. Now let's come to the conclusions here. The protocol has a clear growth story. If you are a fintech app and within the next 12 months you will not offer yield on your customers' stablecoins, you will fall behind. And the easiest way to give yield to your customers is by deploying a vault on the Morpho protocol. At the same time, the protocol is really constructed simply and therefore doesn't require high maintenance costs, which really means increased margins for the platform. More revenue will translate into higher earnings. And there will be a huge network effect because, as I mentioned before, of this shared liquidity layer where all of the vaults can decide to deploy into markets. Ledger users can lend out to Coinbase borrowers, can lend out to crypto.com borrowers, and to any other one who deploys on Morpho as well. So at some point, Morpho will will have such a high moat because they have so much liquidity available that can be deployed into markets that it will be hard for any other lending platforms to overcome. And lastly, there's a clear path to the token value accrual. We will have the fee switch in the future, and then the token can be bought back and redistributed to token holders, or the token can be bought back and burned, or can be bought back and LP'd, whatever the protocol decides to do. Value created by the Morpho protocol will translate into value accrual by the Morpho token, which is really nice. Okay, quick disclaimer at the end here. I hold the Morpho token and this should not be considered financial advice. That being said, I think Morpho is one of the best bets if you want to benefit from the trend that capital is flowing on chain. Alright, that is it with the presentation. What do you think about the Morpho token? Let me know in the comments below if I missed anything in my presentation or if there are other competitors out there that have more potential. See you in the next video. Bye bye.